run through how a 50-year mortgage would work. So, of course, your payments are stretched over a longer term. It would be 600 months instead of the 360 if you're on a 30-year, right? So monthly payments would drop, equity would build very slowly, total interest would be much higher overall. Borrowers could be, you could be locked into your mortgage until, you die basically in your 70s or 80s, right? So,
hey everyone, thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neal and Ryan McNeil. Enjoy.
All right, everybody, welcome back. It's episode 110 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, we are in the new studio live. I guess we're not live, but we're here.
We feel live.
We feel, yes, we are alive.
It is, it's nice.
Yeah.
It's comfortable.
It's comfortable.
I like it.
Yeah. We it's been a work in progress for a while here, but we've been kind of hinting at it, but we're ready to go. So hopefully it's sounding good.
I think it should be better too, because I don't like doing them over the, I say Zoom, but Riverside.
Riverside, yeah.
Which is not, I don't find it ideal.
Not quite the same. It's convenient when we're, interviewing people, of course, that are not local here.
Yeah.
But this is good, and it's good. It's going to be good to be back in studio. Probably our next several episodes. We've gone super heavy on interviews for the past 2+ months here, so
yep.
You're going to be stuck with us for the next couple episodes. But hopefully, we'll continue delivering the content.
Everybody just turned off the podcast.
Yeah, unfortunately, because of you. No, just kidding, just kidding, buddy. Yeah. So where should we even start today? Like we've got a couple interesting topics coming up, but.
Well, you just made a comment, so we can.
Oh yeah. You want to talk about your friends at Remax, what they're predicting next year?
Yeah,
big bounce back.
I mean, I haven't read the article, but my friend just sent me a screenshot of the heading, and
I'll tell you what it says here.
What does it say exactly?
It says housing growth. Market expected to rebound in 2026 as more buyers motivated. Remax forecast. That sounds like a very realtor head office headline.
I think it's fake news. So it does sound like a very realtor type situation. I'm sure they interviewed 5 realtors until finally one of them would say that for them.
For sure.
Maybe in Ontario, I guess, because the prices are like bottoming out. So they think, and rebound in comparison to where it's at now. So
totally.
if a lot of markets are getting destroyed, it might be a little bit better. Yep. Like I also saw a heading maybe yesterday that 50 condos sold in Toronto in the last month, which is like 1/20th of where it's usually at.
Yep.
So I think a rebound in comparison to that, potentially.
It did. The article did quote the Ontario market. Obviously, 50% of the Canadian market, right? But it basically said, inventory's gone up by like over 20% this year, which has created more balanced conditions. And prices were expected to fall another 3-4% next year, which could, spur that activity. So
yeah, I saw an interesting chart yesterday. I think maybe Dan Foch posted it. And it basically compared the affordability to incomes in the different places. And it was like Halifax, I would say for us, was doing pretty well.
Yep.
The worst markets were all the surrounding areas to Toronto.
Yeah, I saw that too. And
financial insecurity, it was unemployment versus proportion of living expense.
Yep.
And again, personally, Halifax was sitting good. It was Halifax, Montreal, Quebec, and Victoria that were really at the best for low unemployment and reasonable cost of living versus your top offenders were Toronto, Barrie, Kitchener, Waterloo, Cambridge, and Toronto.
Yeah, the usual suspects.
But they had the thing that was crazy was the unemployment rate to me. Like Oshawa was posting a 9% unemployment. Windsor's posting 10% unemployment. Toronto is like 8.8% unemployment.
Crazy. Those are Atlantic Canadian numbers.
Those are and then Halifax is sitting at 6.
Wow.
So we were on the better end of it.
Yeah, I'm curious. What did it have? Any other Atlantic markets in there?
Yeah. So maybe it didn't. I thought I had Moncton on here, but maybe I'm lying. No, it didn't have any other Atlantic markets.
Didn't. Okay.
I guess we're just breaking into the scene now.
Yeah, I saw some other post. I think Dan had posted it as well about market affordability or some. It was a more simple measure, and the other markets outside of Halifax and Atlantic were still the most affordable. The Moncton, St. John's,
saw that,
Fredericton. So yeah, it's interesting that it's kind of a weird market, but anyways, I think we're going to go through that in more detail next episode anyway. So
yep.
But the topic at hand today, I wanted to discuss this for a little while because this has been in the news for probably about a month now. 50-year mortgages in the U.S.
Yep.
Okay. and whether this is like an affordability fix or is this going to create a future crisis, and also how this is going to impact, or whether Canada would be likely to follow suit. And I'll give a shout out to my wife Aaliyah on this one. She actually sent me this one. I think she's trying really hard. She's been trying really hard for a while to get on the podcast, but I'm not sure this is going to be her entrance in or not. But you got a shout out, Aaliyah. So how about that? Let's go into the topic here. Do you want to kind of go through a bit of background on this, or?
Yeah. So I mean, for me, I can give you an opinion. I don't have a ton of background research done on it, but like the idea is being floated in the States that there's a 50-year AM coming. The States, in comparison to our market, runs much longer fixed mortgages. So they're doing they'll have a fix for their entire length of their mortgage. So they'll have a 30-year fixed rate. And whereas in Canada, we do pretty much the longest for residential mortgage is 5. Commercial goes to 10. But you can get, in the commercial world, you can get 40 and 50-year AMs.
Right.
And you do
but
see
amortization is different than fixed term.
Exactly.
Very, very much so here, right? So
when the States talk about it, they're talking about doing a fixed term for that period of time, which I don't know. I actually want to spend some time doing some research on the comparison in the markets of what this does, but we'll talk it out and just kind of see what comes of it. Trump's doing everything. Trump's whole entire cabinet and their whole party is doing everything they can to spur the economy, and so that's where this comes from. And so when you think about a longer fixed term, the idea is that people feel even more secure and hopefully have a more stretched payment as well. So it'll reduce the overall cost to get into a home, which the two things that usually happen is you get a big spur of activity, but you also get a huge growth in real estate values, because whether we like it or not, people payment shop effectively. And so if they can get an $800,000 house for $1,800 a month versus a $600,000 house, they're just willing to spend that much more money. And so it'll prop the whole market up and drive this huge equity growth, which in turn makes a lot of people feel a lot more rich because the value of their homes will go up, or people will sell for a higher price. And it just injects a ton of money into the economy, basically via the banks and debt.
Yeah, and these long fixed terms obviously would reduce your exposure to volatility in the market with different cycles, right? In terms of the fixed rate or the policy rate changing, right? So, but I'll run through how a 50-year mortgage would work. So, of course, your payments are stretched over a longer term. It would be 600 months instead of the 360 if you're on a 30-year, right? So, monthly payments would drop, equity would build very slowly, total interest would be much higher overall. Borrowers could be, you could be locked into your mortgage until, you die basically in your 70s or 80s, right? So if we looked at, a mortgage, let's say it's a $500,000 mortgage, your payment could drop by a couple $100s, but the lifetime interest is going to increase by probably hundreds of thousands of dollars over that. So, it prioritizes affordability optics rather than building long-term wealth. Does that make sense?
Yeah, it does. It does and it doesn't, because I think that's something that everyone obsesses about, is this idea that your total interest skyrockets, and the banks are doing this just to make more money. And I agree and disagree at the same time, because I'm yeah, there's more interest being paid, but you're also borrowing more money for longer. So it's not like it's an unfair charge that's being created by doing this. It's not like they're making up some additional way to make money at a higher rate of return than they were originally. They're basically saying, here's an opportunity for you to borrow more money for longer, and we just continue to charge for that. So it's not like there was it's not like it's additional cost to a consumer. It's just basically allowing the consumer to carry more debt for a longer period of time. And so you just pay for that.
Same as on a car payment, right? Where you extend it to 7 years or 9 years instead of a 5-year term, right? And you get those lower monthlies.
Totally. I just remember as soon as this came out, whatever it was last week or 2 weeks ago, for me, my whole meme feed was just people being this is the banks finding a way to make more money. And I'm in some sense, yes, but it's actually the two things that come of it is it's also allowing more people to get into homes, and the people that are in assets will end up making a fair bit of equity growth and wealth generation by doing this. And so these systems have to be they're designed, the government wants these to happen because it's really good for them and it really helps to inject a bunch of cash into the marketplace. But the cash does come from banks, and the banks do charge an interest rate.
They got to make money.
They're a business that yeah, exactly. They need to make money on their money. So I don't know. It's just funny how the different news cycles that come out of these things, and like people don't see it as a positive opportunity for asset bearers and for new entrants trying to get into the marketplace. Totally. Like it should be like, oh, I see this. Okay, if this is going through, now it's probably a good time to buy because this will likely drive values up, and I can get in for a lower payment. And I don't think paying off the mortgage really in any first world anymore is like kind of the idea. Like the idea is there's almost a basic balance of debt that gets carried against these properties, and you're hoping to see some equity growth over the years.
Yep. Yeah, 100%. The mindset has changed, right? So Neal, why is the U.S. considering this?
So I kind of chuckle because they say severe affordability crisis, which is true. When I consider it against our prices in Canada, I'm like, they're like, we're hitting close to 30% of people's incomes going towards housing. And I'm like, God, in Canada, we're at like 60%.
You know why? Because they've already gone through the housing meltdown in the U.S., so they're more cautious about this maybe, right?
Yeah, exactly. We might feel a little different in a few years. But anyways, so they're one piece of severe affordability crisis. Politically, it's again making monthly payments lower so they can advertise that like, look, it's hard to get into a home. This will make your payment go for your first house from $1,800 down to $1,400, so it's much more obtainable. The U.S. market structure we have in here, it allows there's a big secondary market for securitization. Most of you have heard about that if you've watched The Big Short, where they securitize and sell off the mortgages. And so for investment firms, the longer dated mortgages like this are appealing because it gives them a secured income source for a longer period of time. So we have in here Fannie Mae and Freddie Mac are backing it. It also fits into the toolbox of U.S. policy ideas to help first-time buyers. So again, it just fits that narrative of being like, we're helping people get into it.
Yep.
My perspective on it is like, that's the political reason that they say it is. The actual reason was what I was kind of rambling about before, which is this will help to drive up asset value, land value, basically. So states, by doing this, they can say, look, our land base is worth, let's say, $1 billion. If we are willing to extend debts to 50 years, we may be able to juice that value up by 20%. So add $200 million, which oftentimes gets injected into the economy by additional spending. So it's a huge boost for the GDP to do this. By extending more debts, you can basically get your general consumer base to spend more.
Yep.
And so it's good to try and, again, it's good to try and keep the economy growing. It's a dangerous thing though when you keep adding more debt onto people's plates.
Yeah.
You have to be cautious in that. And if the growth stops and people are carrying the bag on these, because to your point, in the first 5 or 10 years, they may have not paid it down at all.
Exactly.
So if there's ever any pullback, you can get in this position where a ton of people are upside down.
They're underwater.
In private lending, time is everything. The faster you move, the faster deals close. At Mortgage Automator, we build a platform that transforms how credit unions and enterprise lenders originate, service, and scale their business. No spreadsheets, no chaos. Just precision, automation, and control. From loan origination to servicing and investor management, every step is seamless so you can focus on what matters most. Growing your portfolio and customer base, not managing it. From AI to compliance and everything in between, Mortgage Automator is trusted by hundreds of private lenders across North America and is the highest rated platform on G2 and Capterra. Mortgage Automator, powering the future of private lending.
That's a great segue into some of the risks and criticism of these potential introductions into the U.S. So from a financial perspective for borrowers, obviously we talked about, the interest costs ballooning over a period of their lifetime.
Yeah.
Potential very slow equity growth depending on, home price growth. And like you just mentioned, Neal, borrowers potentially going underwater in those first 5 to 10 years as well. And then people, this may or may not matter for an individual, but you could stay indebted well into your retirement and always have that mortgage payment there, right?
Yep.
There's also market risks to consider as well. So these longer amortizations could actually inflate demand, pushing prices way up like we've seen here in Canada. And then there's obviously the potential for default risk because of that thin equity cushion that we just kind of mentioned there as well.
Yeah.
Policy concerns. This doesn't necessarily address the big issue of the lack of supply. This is not introducing new housing stock into the market, right? You look like you got something to say on that.
I was just like, I'm like, it's funny, like the political mandate and like the way they advertise it, like we want to address supply issues and make it more affordable and blah, blah, blah. Not that I'd say like they don't and they're the big, bad, evil person. They're trying to keep a country running.
Yep.
And for these first world countries that we live in, it's super crucial that the assets continue to grow in value.
Yep.
And as time's going on, everywhere's basically, I feel like every place gets to a point where the standard of living gets so high that the general consumer starts to have a distaste towards industry because industry isn't as sexy as we believe it is. If you're not in it, it's hard to imagine what goes on in the background to make your life the way it is.
Yep.
So then one of the biggest ways to drive value is through real estate. If you fill the market with supply, prices are going to go down in real estate. So the government has to say that they are, but literally do the opposite because they will be shooting themselves in the foot if they add a bunch of supply to the marketplace. And we're seeing
because they want prices to go up, is what you're saying.
They need prices to go up.
Sure.
You know what I mean? Like and we need prices. Like the average consumer needs them too. Like everyone says they all want supply. I'm like, okay, cool. So then let's say we add a bunch of supply, and now look at everyone here in Halifax. Our average price is whatever, $600,000-$700,000.
I knew you were coming back to this.
If it goes to $200,000, if it goes to $200K, they're not going to be super happy.
Right.
Like if you think about what's happened over the last 5 years here, our average price was whatever, $270 5 years ago.
Yep.
And then you drove around the streets and just looked at what people's houses look like, what cars they drove, what restaurants they ate at. And now we've had this big growth in housing, and everyone likes to be super like, whoa, like people living in their $1 million house like to be like, oh my God, we need more housing supply. But they're also now driving a new Mercedes-Benz and they're eating at the nice restaurants, and they've gotten all this new landscaping done at their house. Yeah. They weren't going to do that if their house was still worth the $400,000 it was 5 years ago, and they wouldn't have been driving that, and they wouldn't have been eating there, but they feel wealthy now because they just made $600,000 on their house.
Do you think this directly coincided with why we've had so many new high-end restaurants pop up in Halifax in the last 5 years?
100%. And like Audi, they built a bigger Audi dealership. They built a bigger Mercedes dealership. They built a bigger Lexus, an independent Lexus dealership. That's not because we have all these new high-paying jobs. Yeah. Like how many people do you know that 5 years ago were making 100 that are now just making 350? Yeah. They're not. And proof of concept is we're having more strikes than ever. So that strikes happen when people don't have enough money to pay their bills. So that means wage growth has been non-existent. Everyone likes to talk about that. Yet spending's through the roof. Yeah. Every luxury thing here. We have a Rolex store. We have like more jewelry stores. We have all these fancy gyms. But it's what happened. Yep. Our real estate went up in price. But so if you add a bunch of supply,
10% of Toronto moved out here too. So
10% of Toronto, yeah, true. But anyways, that's my thing.
I like that. I like that sidebar there. So again, like from a policy perspective, this is kind of seen from analysts more as like a Band-Aid solution rather than actual like structural reform, right? From a lender perspective, you know, it obviously makes it more challenging to price in longer term risk. Yeah. You know, more sensitive to rate changes. And requires, this is one thing too that we don't really dive in as deep here, but the securitization of this as well, right? Where you're having these 30, 50-year mortgages, right? Like that becomes a big play, and like tying it back to the Big Short that you mentioned earlier, right? Like this is like, is this really going to be a good thing long term, or is this just a political play?
Exactly. I'm not as familiar and comfortable to comment on securitization markets, but I would assume if the world economy starts to lose faith in a certain country and they're unable to then sell and securitize these, you get in a position where then they can't offer them. But if you've begun to and inflated the market based on these, and then you have to pull that back, it's really hard to then pull this back. Yep. Right? Like you start adding in all of these additional debt structures to reverse that. Like we just talked about, if you're not paying things down much and the asset growth kind of goes away, then you get in this place where it's a double down effect where it's like if people stop wanting to buy these loans off the lender's books, and then they can't offer them, and then because they can't offer them, the market starts to go down, which then reinforces the point of being able to not sell them. Yep. Anyways, it is a risky thing to then just be putting more debt. But if you look at the last 100 years, every place it's credit cards, car loans.
Seems to be the way the world's going.
Now we're financing pizza.
Yep. I haven't tried that yet, but I'll have to look into it. Let's go into the Canadian market, how this contrasts.
So like we talked about, like the longest terms typically that you see here for a res mortgage is 5 years, which I guess in some sense is kind of good because it gives us an opportunity that if we ever want to start adding in these longer AMs, we can. And I think it maybe helps to keep our consumers on side a little bit more because they have to be a little, like 5 years is not long. And so you always have to be considerate of the fact that like, yeah, I'm signing a 2% mortgage today, but I very well could be hit with a 5 or 6% in a very near window to me. And so, yeah, we lend on a different basis for that. And I think that's also where we have like stress testing is a little bit more important too, because you could have a swing in a short window. Like, and most people are probably, I'd say, probably taking closer to 3 to 4 years. I don't think every, you know what I mean? I think I don't know what that allows us to do though. Like we have long AMs though. Like our amortization is still quite long.
Yep, 25, 30 years.
Yeah, and they've floated the idea of 40.
Yep.
And they've had them in the past.
It came in at one point, but then it's been reduced for insured mortgages down to 25.
Yeah.
But I mean, just in general, the Canadian market is just so different where most lenders are lending on their balance sheet, less securitization overall, though some lenders still do that, fewer long-term fixed products. And we have our stress test rules as well here. Mm-hmm. So it's just not really built for these longer fixed-term mortgages.
It's interesting. We rely on supply constraint more than debt on the valuations for residential property. I think maybe on the commercial and multi-unit side, we rely more on the debt growth.
Yep,
that's what it seems like.
Yeah. I don't know as much about that to comment on it, but just on the amortization piece, you just kind of mentioned it, Neal, but Canada's actually reduced it over the years, right? Yeah. So before it was 40 years, went down to 35, 30, and down to 25. And, there's been talk of bringing that back. And I think there was some legislation introduced last year that increased for certain like first-time buyers as well to make it a bit easier for them from a cash flow perspective to get into the market. But
that's insane when you think about the fact that we've been reducing the AMs and the prices are continuing to just grow and outpace big parts of the world.
Yep. Yep. And
what the hell's going on?
I don't know. Well, apparently, so it's if you look at like the regulator perspective, they're saying they're prioritizing stability of the market over monthly payment optics. So optics, exactly, right? Keyword. So, and I'm not sure we're the most like stable market right now. I don't know if that's a good way to describe the Canadian market, but at the end of the day, like Canada's just not going to do this. They're not going to go the same route that the States is, right? So they see, systematic banking risk here, whereas like historically, maybe less so in the last couple of years, our banking system has been like a global standard for stability.
Yeah.
Right. And, you buy RBC, you buy CIBC stock, and it keeps going up 5%, whatever, 7% a year and pays you a nice dividend or whatever, right? And we don't rely on that securitization like the U.S. market, right? Where they see, back in the 2008, 2009 market when everything started to fall apart there due to a lot of that securitization.
Are you a private mortgage lender in Ontario looking for trusted legal support? Meet Grecky Carter Professional Corporation, a boutique real estate law firm in Midtown Toronto with deep expertise in private lending and mortgage enforcement. Grecky Carter closes hundreds of private mortgage deals every year, and when recovery becomes necessary, they handle both contested and uncontested enforcement with precision, from forbearance agreements to power of sale and cost recovery strategies. For lenders who demand clarity, efficiency, and results, Grecky Carter has you covered. Visit gclaw.ca to learn more and safeguard your private lending investments.
It's nice. I'm liking the fact that we have this kind of in the back pocket, the ability to extend these amortizations to help bring people's payments down if need be.
Yeah, it's just interesting because our market, like we talk about it all the time, how diverse the market is across Canada and how much leveraged we are in the GTA and GVA in terms of population size.
Yep.
And it's tough to have these like broad strokes across the country to apply these new pieces of legislation in to change mortgages where they may have the opposite effect in certain markets.
We do have such polarizing marketplaces.
Yeah.
To your point, the GTA and the GVA, I haven't heard that before. The GVA are so different than pretty much the rest of Canada.
Yeah. Whereas the States, like obviously you do have those more dense pockets, but it's more dense across the board in the US, right? So I mean, I don't know. Obviously there'd be changes state to state, but in Canada it definitely feels very fragmented, our market.
Yeah.
Right? So in terms of, other reasons why Canada won't do this, I mentioned the securitization, harder for lenders to hedge against long-term rate exposure, could inflate home prices even more than it already has, and, contradicts, our tightening regulatory philosophy that we've seen in the last several years.
Why do you think we have this continued price growth with reduction in AM? Just purely supply?
It's definitely, that's the root of it. I would say that's the vast majority is a supply problem overall. Obviously, it's been coupled with mass immigration in the last 5 years, which now we're seeing that being pulled back. So you're seeing, like we mentioned off the hop here, the markets like in Toronto or Greater Toronto starting to stabilize and become more balanced, and even buyers markets in some areas, right? So it's going to be interesting to see how that rolls out in other markets, the Halifax, the Calgarys of the world. But it's a supply issue is at the core of it, from my perspective.
Yeah, that makes sense.
Yeah. So anything we can tie back to private lending here?
Well,
we're talking long term, but how does this impact things in the short term?
Well, I think to this point, like with these reduction in insured mortgages, I think if you look at the Ontario marketplace, I'd be curious to know what the percentage of mortgages is that have another mortgage behind them.
That's what I was wondering too.
The percentage of seconds and thirds. I bet you there is a huge amount. Like,
you think there is? So I was curious about that, because like when you're locked in for that long, how do you refinance out? You just have to refinance out the second mortgage. You couldn't like bundle them together. If
you mean the States or in Canada?
I'm talking the States. Were you talking the States?
I was talking about Canada, because that's about for pricing.
Okay.
Like I think that's how we're getting to these huge prices as well, is second and third mortgages.
100%. Absolutely.
In the States, this like refi mindset and the fact that the value growth of your property, I don't think that's really something that they operate on. I don't think people there expect to buy a house for 200 grand and then in 4 years have it worth 300 or 400 grand.
But we haven't always been that way in Canada either. That's more of a recent mindset. And it's almost been a necessity because our generations have grown up with such more challenging conditions in terms of affordability of everything.
I agreed. And basically just lack of income growth.
Yeah.
Like when you look at the income growth and the general GDP growth in the States in comparison to us, that's where they're not having to rely on this value appreciation in your assets.
Yeah.
Because there's been more income growth for the general population.
Grown generally hand in hand.
Yeah.
And do you think it's as a result of these more fixed term mortgages creating more stability? Are we going to talk ourselves into this being a good thing?
I don't think these are the worst things. Honestly, like I think, I don't know. I don't think it's the worst idea in the world. I don't think it's a result of this though. I think it's more policy and tax policy outside of real estate that's allowed them to work off of on that growth versus having to rely on real estate growth.
You mean in terms of being able to obtain personal income or successfully start a business and not be taxed at 50% marginal rate or whatever?
So people don't look to their home to rely on that growth to survive.
Yep.
I think that's what it is. And then additionally,
makes sense.
I also think in most Americans, maybe not most, but in my experience in the States is in general, the zoning laws tend to be a little bit more relaxed. And it's funny, being down there, I can appreciate our zoning laws because our cities feel very organized and clean and simple.
Yep.
And I sometimes find myself in the States where I'm like, this is weird. I'm in suburbia. And then there's like a Dollar General in the middle of a random street. I'm like, what the hell is going on here? And like just weird stuff that like makes no sense to me. Or like there'll be an apartment building next to an industrial warehouse. And I'm like, what the hell? Like they just let this go. But by doing that, they've also kept their prices much more reasonable, especially in comparison to the incomes. Yeah. So to have these really clean cities where it's like we have very succinct cores and very succinct suburbs is very expensive for people to be able to live in. Yeah. So I don't know. It's like So let's take a look from a private lending perspective. Let's look from the U.S. perspective. So if U.S. was to adopt 50-year amortizations or 50-year mortgages, I mean, private lenders are short-term in nature, right? So they're just not going to be offering something like this. But it could impact demand for private lenders as well if from the perspective if monthly borrower affordability improves and more people qualify for these mortgages with institutional lenders, then that may reduce the need for borrowers requiring alternative or private financing. Yep. You're still going to see more of the higher risk borrowers looking for alternative solutions, which is not necessarily ideal to the private space. Obviously, higher risk of default in that scenario. Yep. And more borrowers could be stretched thin on these longer amortizations as well, right? Yeah. So I don't. Yeah. I feel like they still do the same due diligence on these people. It's just if you get in hot water early on. But again, they don't think they rely on, like here, it's like if you get in hot water, everyone's like, well, I'll take a line of credit on your house and you can survive for 5 years and then pay it back and move on or sell the house and get out. I don't think that's the mindset there.
Yeah. Yeah, fair enough.
Like, I think people look at a house
enough about the market to comment, but
yeah,
that's interesting. Interesting thought. So in Canada, I mean, private lenders could benefit from the current regulatory, or private lenders already do benefit from the current regulatory environment with our shorter amortizations, with the stress test, and we're continuing to see stricter lending rules. So in a couple episodes, Neal, we're probably going to have some of our predictions for next year and a little recap of 2025. Mm-hmm. But one of mine, I'll just share a little nugget here. One of my predictions is going to be that we're going to continue to see the increase in market share for alt and private mortgages into 2026 and beyond.
Oh, 100%.
Right?
100%.
Yeah, because it just continues to tighten and tighten and tighten. And you saw the news the other day that they're trying to like loosen certain areas, but it's really not going to have any impact on like the market outside of, you know, single family, first time buyers, which is really not the typical target market for private lenders.
Exactly. And I think this market correction is a great opportunity for alternatives to come in and scoop up a bunch of market share at, I think currently based on paper, a perceived higher risk, but if you have an understanding, I think, of the real estate market, it's a lower risk than when it's funny, like when the market was hot as hell and prices are skyrocketing, it feels technically on paper, it's like low risk because there's all this growth going on. It's a great time to put money out. Yeah. But actually when you have that reduction in pricing and kind of this almost turning to a buyer's market, from my perspective, it's a good time to get money out because ultimately your prices have come down so much.
Yep.
But on paper, again, just of what's going on, it'll seem worse. And so the big five might have less money going out in comparison to when they would during the big growth windows.
100%. It's always scary when you're putting money out and the appraisal from 6 months ago is now 100K higher than it was before, and it just continues to climb. Like, that's not an ideal scenario to be lending 80% loan to value on.
Yeah.
Right? Why don't we wrap up with what this could mean for borrowers, Neal, before we put this one to a close?
We talked about it, lower monthly payments. Worse long-term financial outcomes. I'm going to disagree-ish just because, again, you're just paying for the money you're borrowing, but it is expensive. In Canada, we're going to continue probably more conservative mortgage structures, which will, we feel, protect the long-term borrower's equity. I'm also going to somewhat disagree. I think, again, these are what, on paper, how it works, but I think what ends up happening in practice is different. And what we have on here is, would you rather qualify today with lower payments or actually build equity and wealth?
Yeah.
The way that's phrased, obviously, I want to build equity and wealth.
Yep. But some people don't have that choice.
And I think as investors in real estate in Canada, you are doing a 50-year AM. I know it's not locked in for that whole term, but you might get a 10-year fixed on a 50-year AM. Mm-hmm. And a lot of the big builders are maybe between 40 and 50-year AMs. And that's because in Canada, we're banking on equity growth. So if you can get more debt or a bigger project, the hope is, okay, maybe you could have bought $1 million property and that grows 50%, so you made $500,000. But if you can get this long AM, maybe you can buy a $2 million property. If that grows 50%, you actually made $1 million. So that's why I'm like on the fence about all of this, which is a lame answer, but there's merits to it. I think if someone goes into it aware, it's just tough as a consumer sometimes to try and make the decisions because how can you be expected to be an expert on all of this?
Yeah, this is kind of a tough one to form like a concrete opinion on. Just like given we talked about just the geographical differences in the economies between Canada and the U.S. Obviously, we're neighbors, but just very different from a housing market perspective. How it's structured from a political perspective. So, I think it's probably a good time to wrap up. I think we're a little bit choppy today, but that's all right. We're settling back in to the new spot here. So, of course, we mentioned, U.S. may experience with 50-year mortgages. They already do 30-year mortgages, but Canada almost certainly won't follow suit here.
Yeah.
Okay? We just said it. The regulatory systems are fundamentally different between the two different countries. And, these long amortizations could look attractive today, but could come with meaningful long-term risk. It really is dependent, case by case in this scenario, right?
100%.
Anything else you want to add on this one, Neal?
No, I have about a million points I want to make, but I can go forever.
Save it for the next one.
Yeah.
Encourage you guys to subscribe if it's your first time listening. We're going to continue to pump out content about the Canadian mortgage market and the mortgage broker space. And if you want to chat or provide suggestions for future topics, just let us know.
Tell us if you like our new studio.
Yeah, please do. Check out the YouTube page, and we'll catch you next time.
Thanks, guys. Thanks for listening, guys. It's Neal, your co-host and co-founder at Keystone Mortgage Investment Corp. and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan McNeil. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.